Good afternoon, good morning, or good evening, depending where you are in the world. Welcome back to Valutrades and the first webinar of 2021. Firstly, welcome to 2021. Let's all hope it's a better year than last year. Well, that was a lot of fun. I don't have to tell you what was going on, but I don't know about you, but I'm stuck at home now. Our town is shut down. I live in southern Spain. I went out shopping today and everything was closed. So we're all stuck at home with our barbecues and everything else that's going on in our gardens. So let's hope we all have a lot more time to do our retail trading and home trading. So our idea is to help you with that trading, help you not to lose money, and hopefully make some money with value trades. So welcome back to our webinars. We're going to be looking at oscillators today, as you can see by our exciting title slide. My name is Brad Alexander. I've been doing quite a few webinars for Valutrades over the years, and I'm really glad to see you guys here. So very quickly, just type some questions into the question. I want to see who's with us these days. Just pop a chat or a question onto the chat line. I'd like to see who's attending these days and how we can help you. If you have any questions during the webinar, please feel free to drop them down. I'm happy to stop as long as it's pertinent to the topic, which today is oscillators, and we'll carry on. Okay, as I said, my name is Brad Alexander. I've been working with value trades for many years. I'm a professional trader and I've been a retail trader, of course. My day-to-day job is to provide content to the FX business. I work for, obviously for value trades and some other brokers, and I do a lot of work with fintech companies. So I see a lot of different platforms and a lot of exciting tools that are out there. And I've done literally hundreds of videos on MT4. So we'll be looking at that today, of course. And I also do the market blasts every Monday and Tuesday. And if you don't subscribe, I would highly recommend that you get onto the Valutrades website, check on trading tools, and subscribe to market blasts. So I do a market blast fundamentals every Monday, which has of course been published today, and a market blast technicals on Tuesdays, Tuesday morning, London time. And of course, we talk a lot about oscillators. We love our oscillators. We combine oscillators with our other indicators and also fundamental analysis. And that's what today's topic is about. We're going to be looking at different types of oscillators, specifically MACD, RSI, and the stochastic oscillator. And I'm going to give you a spoiler alert. My favorite is the stochastic oscillator, but I'll let you guys decide as we go along. So before we get going, of course, we need to talk about our disclaimer. CFDs and FX are leveraged products and your capital may be at risk. So I would highly recommend that you read the disclaimer and risk notifications on the Valutrades website before you risk any real money. Always try to scale in your money. Don't risk any more than you can afford to lose. Have fun with trading, but be very careful and follow our lessons and watch your risk management. So today we're going to be looking at not just oscillators, but I want to talk about the overall look at technical analysis. There's no point in simply looking at one simple indicator and expecting you guys to run off and trade and make a lot of money. You need to have a package of indicators. You need to be able to confirm your trades, and using an oscillator is an excellent option. It's what I do all the time. But you need to combine that with other technical analysis methods. So we want to take a look at an overall look at technical analysis before we get going. I want to look at the order of analysis as well. This is very important for me. For example, I don't trade unless I know what's going on fundamentally. I don't just jump into candlestick patterns or what the oscillator says. I have a specific order that I follow before I open a position, and I'm going to be looking at that as well. And of course, we'll look specifically at the oscillators that we've promised to do. And how to set up oscillators. Not every indicator, if you're used to moving averages, you know very well that you can adjust moving averages. You can also do the same with oscillators. It's not always necessary, and you may not want to, but I will show you how to set these up as well. Many of the platforms like MT4 have already set these up for you with the optimum solution, the optimum way to trade, but you may want to tweak things as you go. So we will be looking at that as we go along. and also combining oscillators with other indicators. Again, if you trade specifically with oscillators, you may not be successful. So we want to show you how to combine different indicators with oscillators. I've seen many cases where a lot of traders will have literally 8, 9, 10 indicators on a chart, and you get into analysis paralysis. I've seen other traders who will just trade naked and literally just go on a whim and lose their accounts. So there is a happy medium in between. We're going to be looking at some examples today of how to combine oscillators with other indicators and how to confirm your trades before you get involved. Okay, very quickly, I want to go over a bit of technical analysis and what it's all about. Technical analysis is basically looking at the charts, and I like to break it down into 4 different categories. One is historical indicators, number 1. Historical indicators include things like moving averages, Bollinger Bands, parabolic SAR, and it includes the oscillators as well. Many analysts call the moving averages and so forth, Bollinger Bands, a lagging indicator because they're looking back at price action that's already happened with mathematical calculations. And they call oscillators leading indicators because they actually will do different mathematical calculations, which we will look at later. I'm not sure if that's a correct terminology, but we look at, when I say historical indicators, I'm talking about anything that looks back on price or back on the speed of price change and creates a calculation which we can put on a chart. So that's what an historical indicator looks like. Secondly, are chart formations and patterns. These are, for me anyway, critically important, whether it's, and we will have other webinars and lessons on that. In fact, there are some lessons available and videos on the Valutrades website. And if you do follow my Market Blast technicals, you'll know I'm always drawing triangles, I'm always drawing pennants, rising wedges, falling wedges, support and resistance. It is critical that you understand this before you place any trades. So what we like to do is combine our chart formations and patterns with the oscillators to give us a better idea of how to enter a trade. So that's the second point on technical analysis, chart formations and patterns. And I like to tell a lot of, fundamental people that chart formations and patterns are actually a reflection of fundamental analysis on a graphic form. Very often, for example, pennants will indicate the battle between buyers and sellers. So if you can't see it in the newspaper or you can't see it on Bloomberg, you can certainly see it on a chart. When you've got a consolidation pattern, you see price bouncing between 2 levels. That is the battle between buyers and sellers. And for me, that is the graphic representation of fundamental analysis. So to me, it's critically important. Number 3 is candlestick formations and patterns. Again, we like to combine all these things, whether you like to simply trade based on candlestick patterns, if you like watching dojis or three black crows or morning stars or hammers, it's all excellent stuff. There's no problem with that at all. I don't base my trades on candlestick patterns, but I like to use them as confirmation tools, especially in reversals. If you follow any of our webinars and videos on candlestick patterns, you will note there are some clear ways to find reversals using candlestick patterns. So if we, for example, combine the first 3 historical chart formations and candlestick patterns, you've got quite a good system set up to trade with which to trade. And of course, 4 is Fibonacci. Fibonacci is not really an indicator, it's actually a graphic. But the one thing about Fibonacci, which is really cool, is that many people use it. Many banks, many hedge funds, even I know crypto traders use Fibonacci, and it's almost a fait accompli when price hits a Fibonacci resistance level. It is an indication to the world that it's time for a reversal or a time to sell or a time to buy. So it happens because it happens. It's not very technical, not very methodical, but it's one of those things that when people use Fibonacci, it simply works. It doesn't work for everyone. So combining all of these lovely indicators, historical chart patterns, candlesticks, and Fibonacci can serve you well. If you put too much on a chart, obviously you're going to be confused. So it's up to you to create your trading pattern Today we're going to be talking specifically about oscillators, and we will have some examples where we use Fibonacci with oscillators. So there's a lot of ways to get through this. Right, I talked about my order of analysis. Sorry, give me 2 seconds, guys. I was recently doing some classes, and I could see my students were getting a bit confused as to what to do, which way to go with trading. So I created my order of analysis. Before I enter a trade, I want to know what's happening fundamentally. And what that means is what's happening in the news. Technical analysis, as we just saw, is about what's happening on the charts. Fundamental analysis is what's happening in the news. And very basically, if you follow my Market Blast videos every Monday morning, you'll know that there are two kinds of fundamental analysis. One is items that we know about, which are clearly labeled on the economic calendar, and items that we don't know about. For example, if a war breaks out or a tanker is seized in the Gulf of Hormuz, or suddenly the Chinese government decide to issue a trade barrier against some country, or heaven forbid, Donald Trump sends out a tweet. Well, again, welcome to 2021. As of Wednesday, in fact, as of last week, we won't have that anymore. So if you've been trading for the last 4 years, you will know that tweets from the President of the United States have very often sent your price action in the wrong direction and probably back in the other direction very quickly. Very annoying. Again, welcome to 2021. We hope that Mr. Joe Biden doesn't do the same thing and we can get on with our trading in a sane manner. So that's fundamental analysis, like it or not. So I don't open any trade unless I know what's going on. For example, right now, if you caught my video this morning, oil is being very seriously affected by COVID lockdowns. Nothing is going to change with oil, technically, which way or the other, unless we get some better news on COVID. It's as simple as that. When oil is affected, it affects the Canadian dollar, and it's a ripple effect like that. So I need to know about the fundamentals before I start trading anything technical. I next like to look at support and resistance. Support and resistance is critical in every single trade. Very quickly, if you followed any of videos that are on the Valutrades website, if you, for example, sell too close to a line of resistance, you could get stopped out, or buying too close to a line of support. You need to know where your lines of support and resistance are, and you need to be very careful, either waiting for a bounce or waiting for a break. So that is a critical factor before you open any trades. It doesn't matter whether it's an oscillator or using an oscillator or another lagging indicator. Without knowing where your support and resistance is, you're basically shooting in the dark, and it's very easy to find. Chart patterns are very critical for me. Again, if you've seen my videos on Tuesdays, I'm always looking at ascending, descending triangles, wedges, pennants, and so forth. I'll give you a quick chat. I know one particular broker, and particular educator who lives and breathes on supply and demand. Well, I did a study a few years ago and found out that their supply and demand was actually based on falling and rising wedges. So I managed to supersede all of his expensive signals and expensive classes with a simple set of a simple set of rising and falling wedges, and they're easy to find on any chart on any time frame. Right, and then the indicators. So I'm going to review the list. Fundamental analysis is critical, knowing what's going on in the world. I won't trade, for example, right before the non-farm payrolls because I know the markets will be too volatile. I need to know my support and resistance on any pair. It doesn't matter what it is. Chart patterns I'm quite fond of. And then I'll use my indicators, whether it's Bollinger Bands or moving averages, or in fact, the oscillators we're going to be looking at today. And then I will confirm that with a candlestick pattern. If I don't see a candlestick pattern I don't like, I'm not bothered. I really am not bothered. But the other 4 on top are quite critical. Candlestick patterns are a very convenient way to add an extra layer of confirmation onto any trade. Okay, let's get to the topic today. So oscillators is what we're talking about. I'm going to turn off my camera so you can see the chart a bit better. Let me make sure I'm sharing the correct screen. Yeah, yes, I am. Thank you very much. Right, so on MT4 and on Valutrades MT4, simply click on indicators and scroll down to oscillators. And you can see a very long list of oscillators. There are quite a few. You can play around with as many as you want. There's one on there called average true range, which is not really something that helps you trade, but it's an excellent oscillator to help you gauge market volatility. And I've definitely done videos on that before. The ones we want to concentrate on today are basically the ones that are on top, the Stochastic Oscillator, MACD, and the Relative Strength Index. Okay, and again, I encourage you to take a look at the rest of them. I don't use them personally, but there are some. If you talk to 1,000 different professional or high-end retail traders, they will give you 1,000 different ways to trade forex, and a lot will tell you that they use this or they use that. Feel free to try whatever you want. Whatever you are comfortable with is absolutely fine with the rest of us. But I would highly recommend you take a look at these 3 oscillators if you're just getting going or you want to tweak your trading strategies. So let's take a look at MACD. MACD stands for Moving Average Convergence Divergence. And hopefully by this time you know what a moving average is. I don't want to go through that. It's a very important part of trading, understanding moving averages. And the reason we call it moving average convergence divergence is simple. The way this works, in fact, on MT4, on Valutrades MT4, it's created a little differently than some other other MACDs. And you can see on this slide how it's displayed as a box below the price chart. You can see the gray lines are called the histogram, and the red line is called the signal line. Well, the way this works is simply that the histogram is created by 2 moving averages of price, one minus the other, and you can see the volatility that is created up and down, overbought or oversold. The signal line is another moving average of the histogram. So basically, you've got a whole series of moving averages, basically 3 moving averages, creating this wonderful chart. You don't need to understand the math totally, but it's important that you get a feel for what it's doing. Okay, so we can use this in many ways. We can look for a crossover, and if you can see on this slide where the red line breaks out of the histogram. In fact, I can see 1, 2, 3, 4 points where if you'd actually taken a trade where the red line crossed out of the histogram on an overbought or oversold situation, you would have been in profit. So it's one of those things where you need to take a look at it and back test it, and you can see, and I'll show you an example in a couple of seconds as to how we might use that. So we've got the one method of using the crossover between the signal line, which is the red line, exiting the histogram, which is the gray bars. And again, not every chart package shows it this way. This is specifically the one from MT4. And to be honest, of all the MACD configurations, I like this one the best. It's much simpler and it's easy to follow. You can also use MACD as an overbought or oversold. And in fact, if you followed simply the, you can see through the middle of the MACD indicator a 0 line. And basically that's obviously a 0 line. And down below, you've got a series of graduated lines going up and down. So the final point of a low point and a high point we call overbought or oversold. Obviously, the higher the point is overbought, the lower the point is oversold. And again, you can combine that with the signal line, the red line. A lot of traders, though, will combine that with the price. If price, for example, if you see on the December 16th slide there, price, the MACD has gone to the low point, oversold, whereas price has gone to a couple of doji candlestick patterns. In fact, you can see 3 dojis in a row there after a very long series of bearish candles, and price refuses to drop any further. So you can consider that an oversold situation and perhaps go long. Coincidentally, the same signal was provided by the red signal line exiting from the histogram. Okay, or you can look at divergence, which is basically the same thing. The lower and higher points of the MACD, basically looking at the price not moving any further, and that's what we call it, divergence. So let's quickly go to our MT4 chart. Okay, here we have a chart of oil. So I'm going to quickly put on an indicator, and here we have here under indicators called MACD. Okay, the way this works, and you can see by your indicator, and you don't necessarily need to change this. In fact, I wouldn't change it. We have two moving averages that are looking at price. There's a fast exponential moving average, which is 12, a slow exponential moving average, which is 26. And the way the histogram is calculated is basically by subtracting the prices from the 26 moving average, period moving average, and the 12 period moving average. Then we have a MACD SMA, which is a simple moving average, which is the red line, and it's looking at 9 periods behind. So don't worry about the math, and let's see what that looks like. Okay, so here we have our MACD, and you can see that we are actually in an uptrend here on oil. This is WTI on the 4-hour chart. We always like to trade with the trend. So basically, one of the things that we would probably ignore in this case is the short signals. But if you did take the short signals, in fact, I'm going to draw, oops, sorry, MACD or MT4 won't let me draw. Pardon me, guys. Let's try that again. There we go. So we can see that where we had the red signal line crossing out of the histogram, we would actually have taken very good trades. In fact, here's another one here, which if you were trading with the trend, and we always say the trend is your friend, here we have a very small dip below the zero line. The signal line crossed out of the histogram, and we could have taken that trade to the long side and the upside and done very well. So you can see how this worked out quite well. Even if you had taken the trades to the short side, to the downside, which we wouldn't do because oil has been an uptrend for quite a while, it worked quite well. So let's take another look at something else. Let's go to dollar CAD. I'm going to go to our indicator list and remove our stochastic and our RSI. And here we have MACD as well. So we can see as of, and this is a daily chart, and we had a massive rise in the Canadian dollar CAD, sorry, on the daily chart after COVID, of course. And if we were to take a trade based on the MACD, at this point, we would have done very, very well. And as we went along, we can see that we had a long, long downtrend. So wanting to trade with the trend, this is one of the things about MACD. It doesn't always behave that well with trends. If I just extend this a little bit higher, you can see that we did have another breakout here. And again, if we'd taken the trade there, it would have worked out well. We would have made some tiny profits trading these oversold situations, but again, we don't want to trade against the trend. We could have made a few pips here and even a few pips here, but again, going with the trend, even a small jump in the MACD histogram proved that we were definitely in an overbought situation. And again, as I keep saying, trade with the trend, trade with the trend, the trend is your friend. So that's basically how the MACD on MT4 works. Let me take a look at another situation. Let's go to perhaps dollar yen. As you know, I like to work with profiles. Let's go to dollar yen. We'll eliminate the Bollinger Bands. Let's eliminate the stochastic for now, and I'll put the MACD on. And let's look at the 4-hour chart. So you can see here, again, we have a downtrend, but let's take a look at all the different signals. And in fact, with the MACD, if you took any of these, Again, signal line crossing out of histogram, you would have made some money. Here we have the same situation. I put the crosshairs on, and you can see what happened. Price, in fact, gave us some bullish signals with some new candles, a doji reversal candle. MACD said we are definitely oversold, and it worked out. So you can see along this particular line, and this is the 4-hour chart on dollar yen, that almost every single signal on the MACD worked out as a positive trade. Okay, you see where I'm going with this. So you can see here we had, again, this is a very similar situation we saw in oil. We had three doji candles in a row. We almost have a bullish engulfing candle. And if we'd taken the trade there, we could have made some nice pips from here to there. So that's about 80, 90 pips if we got that right. So that's how the MACD worked out really well. Here's a situation where if we were trading the trend, we had a downtrend. So we've got 3 points crossing lower highs and a couple of lower lows, not necessarily the best trend line, I apologize. But regardless, we are in a downtrend. We see MACD sort of poking its head above water, the histogram and the signal line crosses through. And if we'd made that trade there, we would have taken some serious pips. Of course, if we'd known that dollar yen was going to reverse, we could have taken this trade as well and made some serious pips, and that would have been roughly about here and perhaps closed at resistance for 153 pips. So here we are again with some very good signals from the MACD. And again, right now, I'm only using the MACD on its own. I'm using trend lines and things like that. Here we have a consolidation pattern here on dollar yen. And if we zoomed in a bit, we'd find that it's probably a double top or something. Yeah, it looks like it was. That's another webinar though. So using the MACD with say chart patterns would work out very well in this situation. So we would have made, again, about 68 pips and so forth. And right now it's just crossed below the zero line on the MACD indicator, which tells us right now that we're waiting for more information on this particular oscillator. So you can see how you can use the MACD just by using the signal line crossing out of the histogram on MT4. Okay, and we could spend probably all afternoon looking at just MACD, but it's time to move on. Let's take a look at, and let's go back to our slideshow. So I'm going to go back to our main screen. Okay, RSI. RSI stands for Relative Strength Index. If you regularly watch Bloomberg like I do, yeah, it sounds boring, but I do. They don't use too many technical indicators, but they do use RSI very often. And it's the simplest oscillator, which is very good for television, obviously. But I know a lot of traders who have very complex trading strategies, and they'll use RSI in, say, place of MACD or the stochastics, just because it's much simpler. And I'm going to show you a couple of examples of how you might use that. The reason the relative strength indicator works is that it's not mapping price, but what it does, it compares the positive price changes to the negative price changes and comes up with an average that basically looks at the positive price changes versus negative price changes, and it plots it on a chart. So we have the same situation that we're going to look at the stochastic, where we've got overbought signals and oversold signals, and you can use that combined with other indicators to give you extra confirmation. We can also use it as a center line crossover. So when the relative strength index crosses above zero, we can consider it an uptrend. When it's down below the zero line, we can consider it a downtrend. So what does all that mean? Well, let's show you with some specific examples. I'm going to go back to our MT4. And let me find the, and here we have it. If you caught my Market Blast technicals last week, you would have seen me point out something really cool. Here we have renminbi, dollar yuan, and you can see that it's been trending down since the end of May of this year. And again, we love to draw our trend lines, and it's painfully obvious what's happening with the renminbi. It's getting stronger and stronger. The Chinese economy is doing one of the better economies in the world right now for various reasons. The American dollar is getting weaker and weaker, as we know. Again, that's all fundamentals. It's down to coronavirus, it's down to stimulus, it's down to the democratic government. It's down to a lot of factors. So again, as I said, I'm not going to trade anything unless I know the fundamentals, and this is a key fundamental trade. Renminbi is strong, dollar is weak, therefore we have a downtrend that is painfully obvious. So how does RSI help us? In fact, sorry, let me get rid of this stochastic here. We'll come back to that in a second. And if you saw the video last week, I want to show you something fairly obvious. If we go back to the end of May, we can see that RSI was actually high at the 70 point, at the line, at the upper line, and suddenly it dropped, and it stayed low. It's below, far below 70 for basically the entire year and into this year. So that tells us that RSI is confirming a downtrend. I mean, obviously, if you've been charting for any more than 5 minutes, you know that this is clearly a downtrend, but you can use RSI to indicate that this downtrend may be continuing. And again, the way RSI works, it compares the price changes, the positive price changes, the bullish price changes to the negative price changes and the speed at which they do that. And here we have a perfect indicator, often very well below zero, certainly below 70, and hovering around 30, which is indicating basically a downtrend, a weakness in dollar, and obviously because it's the correlated pair or the correlated currency, strength in renminbi. So this is basically one way to use RSI just to gauge the trend. If RSI, for example, suddenly popped up, in this case, in dollar and renminbi above 70, we may really want to consider that the trend may be ending and we may be looking at an uptrend. But we won't do that on its own. We will use other indicators, like especially things like support, which in a case, which in a case like this is critically important. We may not even know if we're at support because this has been trending down for so long. In fact, let's take a look at the weekly chart. Yeah, we can see right now that we are past key levels. We are now into almost uncharted territory from about, well, 3 years ago, February of 2018, it was that low. And you can see that RSI, for example, in these cases, was actually quite high between, oops, sorry. Yeah, so basically about 2 years, over 2 years, from June of 2018 into September of 2019, and then it started dropping, and you can see what happened. So here is a situation where we can use RSI to tell us if we're in a downtrend or an uptrend. And again, here we have another painfully obvious downtrend. I'm drawing this very quickly because we need to move on, and you can see that now RSI, in this case, was well below the 70 line, in fact, very often below the 30. So here we have a situation. This is the weekly chart. You may not want to trade weekly charts, but it's good to show you, you know, how this might be used. And again, these oscillators work on any time frame. In fact, I know some traders who like to trade the oscillators on the 1 minute chart for scalping. You need to be careful. You need a bit of experience to use any indicator on the 1 minute chart. That'll give you an idea of what we're talking about with the RSI. Okay, let me go back to our dollar yen chart. And as you see, I like to work with profiles. Let me delete indicator. Let me get rid of these and I'll put the RSI. Okay, this is a 9-period RSI, and it's quite choppy. MT4 typically comes with a 14-period RSI, and let's change that to show you what that means. So basically, RSI is looking back again over 9 periods. In this case, it's the 4-hour chart. So I'm going to change it back to a 14-period RSI, and you can see it's a bit smoother. A lot of traders will want to see a shorter period RSI, so they have more indications above and below 70. Obviously, if you don't want it too smooth, it won't give you much information, or just be too choppy. So let's go back to the recommended MetaQuotes MT4 14-period RSI. And as I say, with oscillators, they're great because you can back test them at any time. So here we have, again, this is dollar-yen on the 4-hour chart. I'm going to turn off the scroll, and I'm going to do a bit of a back test. And you can see it was painfully obvious in a case like this, where we had a huge upsurge in price, dollar-yen, and then we had an overbought situation on the RSI, and in fact it did turn around. And you can see as the trend continued downward, the RSI confirmed it. Down at some points below or around 30 or below 30, jumped up again, followed price. And it's not necessarily to say, well, why am I looking at RSI when it follows price? It is looking at the consistency of the line close to 70 or close to 30. And you need to be aware, again, on shorter time frames, you may want to trade based on RSI above 70 or below 30. In fact, you can see in many cases where it actually did work out. Here's one here where it went well above 70. And if we'd gone a short trade, we would have had to wait a while, but it definitely came down. And again, here we have a situation where it went below 30, just below 30. And in fact, price did in fact rise up. So again, I would generally be trading this with other indicators like Bollinger Bands or moving averages, or even candlestick patterns if that's what floats your boat. But it does give you an indication of how RSI can work for you. And again, I know professional traders who combine RSI with their strategies. And again, I'll repeat, on Bloomberg, they use RSI very often when looking at stocks, at equities, or even metals, because they need to know, again, it's almost a fundamental thing, looking at the difference between the comparison between positive price changes and negative price changes. Okay, let me go back to our slideshow. Right, the stochastic oscillator. Again, this is my favorite, and you'll see why. I don't necessarily mean say that you have to use that as your favorite. It's totally up to you. Some traders refuse to use oscillators at all. Other traders use naked charts. They don't want to know about indicators. Other traders will do whatever they want to do. So I recommend that you practice, back test, use your demo accounts to try whatever strategy you want. All I'm saying is that my favorite oscillator is the stochastic. What the stochastic does, it doesn't just look at different negative versus positive price changes. It looks at the change in speed of price changes. So I heard a great metaphor the other day about the stochastic oscillator. Imagine a rocket shooting up into space. Eventually, it's going to come back down, you hope, in a good way. But eventually, it just doesn't turn around and come back down. It actually slows down. Gravity grabs it, and it actually creates a nice little arc in the sky, and then it comes back down. imagine the stochastic oscillator is doing just that. It's moving up, 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 or down, 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 and suddenly momentum starts to slow, like our rocket, fighting it's got its rocket fuel sending it up, but it's got gravity fighting against it. So eventually gravity will win, the rocket fuel will run out, and gravity will win and bring it back down. The stochastic oscillator is doing a very similar thing. It's looking at price moving up or moving down, but calculating the actual difference in the speed of the change, the speed of the change in price. And that is a very good indication, getting back to fundamental analysis, of what's going on in the minds or the market with buyers and sellers. Right. So it's quite simple to use the stochastic oscillator. You've got either an overbought, which is basically anything that goes over 80 on the scale, and I'll show you that in a second, or oversold, which is anything below 20. Again, it's not a holy grail unto itself. You need to combine this with other indicators to get positive confirmation, but it is quite a good oscillator to use. Right. I'm not going to get into complicated math about this, but one way to use the stochastic oscillator to enter a trade is when the K line crosses the D line. If you see on this slide, the K line is the blue line and the D line is the red line. And I'll show you in a second how we calculate that. So basically what I want to see, for example, is when the stochastic oscillator, and again, I'm going to trade with the trend. I'm not going to make this up and think I can go against the market. So in this case, I'm looking at this chart. We're clearly in a downtrend. I see quite a few situations where the stochastic oscillator has crossed above the 80 line, and the red line suddenly crosses over the blue line, giving me a sell signal. If I was going the other way, it would be giving me a buy signal, but I don't want to do that in a downtrend. Or I could wait until both lines cross below the 80 or above the 20. It's however you want to trade, your risk appetite. You may not want to wait until it crosses 80. You may want to trade simply based on the crossing of the lines. Oops, I've gone too far. Let me go back to our MT4 chat platform, and we will play around with the stochastic oscillator. Okay, let's go to, well, let's stick with dollar yen right now. Let me remove the indicator. I'm going to put on the stochastic oscillator. Okay, we talked about the K line and the D line and the period. MT4 comes with a set of parameters, and it's called 533. I would recommend you leave it like that, but a lot of traders will change these factors to suit their needs. In fact, I know some platforms that actually have like 14, 5, and 3. I find it too choppy, but you can play around with it and do what you want with it. If it works for you, then fine. Again, 5, 3, and 3, here we go. And I've made the lines quite thick to give you an indication of what's going on. So if we can take a look at a few different strategies. In fact, here we have a situation on the dollar yen 1 hour. Let's say, for example, we wanted to take a look here, and we can consider this an uptrend. So let's say we only wanted to take long trades. Here we have, again, a line of support. And obviously, it's in hindsight. I wouldn't necessarily take this trade at the moment because I wouldn't know that the trend was reversing. But if I did, look what happens. We've got stochastic showing us oversold. The K line crosses the D line or vice versa, and suddenly price goes up. So let's say, in fact, let's say I didn't even know we were in an uptrend, and I wanted to trade this particular one when price got to 105.4 yen. I have another situation where the stochastic oscillator broke above 80, and the K line crossed the D line to the downside, took the trade, and if I was smart, I would have made about 25 pips. Okay, again, let's say hypothetically I knew I was in an uptrend. I could do the same trade going north. And if I was happy about that, I would have actually made about 40 pips. So you can see exactly how the stochastic oscillator would be helping us in this situation. And here's another one right here. Again, by this point, we know we're in an uptrend. We see stochastics cross below the 20. We get in here and we're up about 30 pips. And again, I'm looking at this trend line. So in this case, if I were to take a trade right now, I would only want to go long on dollar yen. Let me make sure we're, yeah, this isn't, sorry, let me scroll back here. I'll turn that off. Actually, it must have been back quite a ways. Here we are. Okay, tell you what, let's take a look at gold. Okay, here we are with gold. Let me turn off this. Here we are. Actually, I won't turn this off. This is Fibonacci. And you can see the Fibonacci line here was quite strong on the 23.6% level. And we can see here some quite interesting bounces off line of support. And each time it bounced, the stochastic oscillator gave us a perfect indication that that was going to happen. Not that we would take these trades because we actually had a descending triangle. What I would be more interested in, however, is the other side of the stochastic oscillator. So let's say and in fact, I do this very often, I will find a triangle like this or a pennant formation, get quite excited about it because I see a clear line of support. In this case, it's Fibonacci. It's also just a plain key level, $1,928. But I see lower highs going down, down, down. So I know that something is going to happen because simply it's a consolidation pattern. I'm quite excited about this area here. And in fact, I see that stochastics didn't necessarily pop above 80, but it gave me a good indication that it was going to go south. And if I got in right there, I would have made a nice trade. I could have waited till I hit support and made a few pips, and that would have been, yeah, 36 pips on gold. Here we were lucky enough that it broke through broke through support. And again, the stochastic oscillator gave us a very good indication that it was going to reverse as well. So if I were inclined to go long, I would have done very well with that. If I were inclined just to stick to the short selling, I could have seen this one here and it would have been reasonably good, not too bad. But here's a really good one here. This is definitely a nice smooth K and D line popping above the 80 mark on the stochastic oscillator. And look what happened, bang. Price dropped down below. And in every single case where here's another one where price had dropped below the 20 line, I apologize. And we like this because it actually hit the Fibonacci line, the 50% Fibonacci line perfectly, literally to the pip, bounced back up. So we had an indication of price bouncing off the Fibonacci 50% level. We had stochastics telling us that we were in an oversold situation. We have a bullish engulfing candle, and we have a reversal candlestick pattern here as well. So we had 1, 2, 3, 4 different indications that it was a nice time to go long. So if we wanted to combine things like that, let's put on something like Bollinger Bands. And we can see here as well that price had actually penetrated the lower Bollinger Band, and in fact, closed above the lower Bollinger Band. So we had all kinds of indications that it was going to go. We were good going long on this. Again, it's up to your risk appetite, how you want to enter this trade. Even if you would enter this trade late, waiting for the 20-period moving average on the Bollinger Band, or in fact across above the Fibonacci line of resistance and support, you still would have made a good trade. But you can see here the severity of the stochastic oscillator really moving up and crossing above 80. So you can use this to close the trade as well. Here, if you close the trade a bit early, it wouldn't have helped you. But if we were, again, looking at this Fibonacci line, and again, the upper Bollinger Band, we could have combined that with this overbought signal on the stochastics, and we would have come out of it very nicely with about 100 pips. So that's another way to use the stochastic oscillator. Okay, let's take a look at some other examples. Let's do this. Let's take a look at something like dollar CAD, and we've already got the stochastic oscillator on this. We like to trade on the 4-hour chart. So let's take a look at all the indicators together. So we'll go with MACD. Oops, I'm going a bit too far. And we'll try RSI as well. So we're looking at all the 3 oscillators that we are studying today in today's webinar. And how could this have helped us? Okay, firstly, we can clearly see, and I'm going to undo the scroll button and scroll back a bit. We can clearly see that we were in a downtrend from November until the end of the year. Okay, the stochastic oscillator isn't really bothered with the trends. It just wants to know about oversold and overbought. The MACD definitely likes to know about trends. In fact, you can see here that right about the time that the downtrend started, the signal line crossed out of the histogram and stayed below the 0 line for some time and didn't start to move above until right about here. So this gives us a very good indication that MACD was really helping us confirm that long downtrend that we were trading between November of last year up until, well, December of last year. And again, let's take a look at RSI. Again, this is the 4-hour chart on the 14 period. As you can see here, price peaked at resistance at 131. At that moment, the RSI was at a peak. In fact, so was our stochastics. Whoops. But the important thing to note is that the RSI stayed low the entire period of this trend. So if we were monitoring this trend as we went along, it's hovering around the mid-level 50 down to 30 and below 30. So we had a very good indication that it was that this trend was going to be maintained. And again, suddenly it started to go up about here. It didn't really make any interesting moves until the price had already started moving up, and then it came up to above 70 sort of near the end of December last year. But we already knew about that because price had moved up. But again, you can see quite clearly that RSI was moving back down again, following a downtrend. Okay, and again, if we look at this particular blip of price, we can also see that MACD was confirming the same thing. Let me draw that a bit better. Okay, so you say, great, that's great hindsight, Brad, but let's take a look at it a little more carefully. If we used MACD in this situation to wait until, because we thought we were in a downtrend all year. It's a long, or let's say all winter, from November 13th up until the end of the year. So suddenly MACD pops above 70, above 0, indicating that we are in an overbought situation. The signal line crosses out of the histogram right about the same time that price does in fact reverse. So if you'd use MACD to go short here, you would have done very, very well. And in fact, if you would use the stochastic oscillator at the same time to confirm that trade, again, K line crossing D line to the downside, and so both MACD and the stochastic oscillator were in an overbought situation. And in fact, if you want to get really, you want to pile on, you could also say that RSI was still in a bit of an overbought situation, sorry. So you've got three oscillators in the same area and prices reversing. So if we draw a line of resistance here, let's just scroll back and see what we can find. Sadly, nothing. Yeah, to be honest, even Bollinger Bands don't help us. You would have been good to take that trade, but not every indicator was showing us, except for the oscillators, which is actually a rare situation. You don't often get all the oscillators lining up. So again, I would highly recommend that anybody trading with oscillators combine it with other indicators, or in fact, in this case, other oscillators. Okay, if you've got any questions, just pop them onto the chat line. I'll be happy to answer them. Let's take a look at indices. Indices are very important these days. You can see why, because, well, obviously, with the US economy being what it is, we are actually blessed right now that the markets are keeping us all afloat, and investors aren't that worried about coronavirus. They're still investing in companies and keeping the indices high, which is excellent. Thanks to a lot of central bank action and a lot of very, very important hedge funds and banks and investors. So we are hopefully see the end of the coronavirus problems, and the indices are doing quite well. So let's take a look at the indices and see what we can find out using these oscillators. So here we have a situation in the Dow Jones Industrial Average, where we have a clear uptrend since the coronavirus pandemic started. I'll draw a quick trend line. Doesn't have to be a perfect one. So you don't need a line to show you that we are in an uptrend. So let's just combine. Let's take a look at the stochastic oscillator with our crosshairs, and you can see here that we had a big dip in price back in June of last year. If we just use the stochastic oscillator to time our entries on the short side, or sorry, from short to long positions, we would have done quite well. So anytime that the stochastic oscillator dropped below 20, I would say in almost every case we had a trade. So here I have 1, 2, 3, 4, 5, 6 opportunities. So here's a big one here, obviously back in October, end of October. We had stochastics dipping below the 20 line when the K line crossed the D line, or in fact popped above the 20 line. Price went crazy, and there was a lot of money to be made there. Again, in this case, we only want to trade with the trend. We actually, if we were pessimist and wanted to trade against the trend, we still had these opportunities, but we would not have been completely successful, except for maybe this instance. Oops. Okay, so we've seen how we can use the stochastic oscillator with the indices, and it does generally work out quite well. Let's take a look at another one. Let's take a look at, say, MACD. And you can see, because we're in an uptrend, the MACD doesn't necessarily behave the same. So let me remove the stochastic oscillator. You can see on the 4-hour chart, we've got a bit of a different situation. If we were to trade short on many cases, because you can see, excuse me, that the MACD was mostly above the zero line, it indicated quite well that we were in an uptrend, and that was maintained all the way through. So any case where MACD even slightly dropped below the zero line and the signal line dropped below the zero line, we had situations where we could buy, and it would have worked out quite well. You may have been a bit nervous buying on a signal like this because it looks very, very subtle, but as you can see, it worked out quite well. So let's use the RSI as well to take a look at how strong this trend is. Excuse me. And you can see that quite often the RSI touched the 70 mark. In fact, pretty much all year. So basically the RSI is in the high area, touching the 70 mark, which indicates to us that we are in a very serious uptrend. You can see here where RSI dipped down. This is back just before Christmas when the stock market had a tiny bit of a crash, and RSI, in fact, was quite rightfully telling us that we were in an oversold situation, but that didn't last very long. But in general, the RSI was quite high. So again, both MACD and RSI in this case, excuse me, confirmed this uptrend. So to actually place trades, we can go to our stochastic oscillator and see how that looks on the 4-hour chart. And you can see that almost every single situation where the stochastic oscillator dipped below the 20, and well, here's a couple of cases where it would not have worked, because we were in a downtrend at this point, very small one. But from November of last year up until current times, we've been in an uptrend. So if we take a look at the stochastic oversold situations, we can see that in almost every case, the stochastic oscillator would give us a good signal to go long, where it has dipped below the 20 and crossed over the K line and the D line. Here's one where it simply didn't work, did it? That was an erroneous one. We had recently, in fact, this is just the last few days where we've had the stock market crash. So we have a situation where RSI is dropping, MACD is dropping. So perhaps I would have ignored this situation, not gone long, even though the stochastic oscillator was telling us to. So if you watch my videos on every Tuesday, you'll see me using the stochastic oscillator quite a bit just to combine it with other indicators. Okay, I hope that's been valuable for you. It's been fun for me to go through all these different indicators. As you know, there's a lot of ways you can trade. Watch your risk management, combine your indicators carefully, backtest, backtest, backtest. Don't trade with indicators if you're in a very heavy fundamental situation. We can always advise on that. But whatever you do, stick to your plan, watch your risk management. And that's all for now. Thanks for watching, and we'll see you in a couple of months with our next webinar. Take care, you guys. Bye-bye.